income inequality has reached its highest level in more than half a century. That's according to a new report by the Organisation for Economic Cooperation and Development. It's partly down to the Eurozone debt crisis. Well, Bloomberg's Elliott Gotkine has been speaking with the OECD's Secretary General. Joins us now. Presumably, Elliott, policymakers have, enough on their plates already without worrying about this as well.
Well, you'd think so, but actually what the OECD is saying is this is all related. It's another piece of the problem puzzle for Eurozone policymakers. And so, partly as a result of that, we've now got in the rich world in OECD countries, the richest 10% earning 9 times the amount that the poorest 10% earn. Partly that's down to bankers' bonuses, and that's also partly one of the reasons why we've seen those protests in the United States, Occupy Wall Street and the like, and also protests over here. But of course what I really wanted to ask Angel Gurria was his take on the Eurozone debt crisis. As you mentioned, today we've got Mario Monti presenting 30 billion euros worth of austerity measures to the Italian Parliament, and I asked him if he felt that that was likely to push Italy into recession.
Short-term measures to straighten the budgets and to correct for past trends inevitably have an impact in the short-term growth. There's a trade-off. But this allows for the medium and long-term resumption of growth. This allows for a sounder, more long-lasting recovery.
So short-term pain, long-term gain, but certainly seems to be suggesting that, yes, Italy, Spain and others will be pushed down into recession.
Now, we have French and German leaders meeting in Paris today, don't we, Elliott? And they're looking at solutions for the debt crisis, but their approach, or at least there are differences, key differences between France and Germany. Who does the OECD side with?
Well, he wasn't saying exactly, but certainly we know that Angela Merkel favours fiscal union, where Brussels vets national budgets. Nicolas Sarkozy still wants national governments to have the final say, but Angel Gurria says this is much more important than about what national leaders want.
The question is not whether the wording satisfies Germany or satisfies France or satisfies Finland or the Netherlands or Italy or whatever. The question is whether this clears the market. That is the ultimate test we're talking about, and that is why we need awesome firepower, and we need all the instruments that Europe has. There's no reason why Europe should not be using the instruments that already are at its disposal, including all the balance sheet of the ECB.
All right, and also we've got, I mean, it's a busy week, a lot going on, but amidst all of this, we've also got an ECB rate decision. Most economists expecting another rate cut. Yeah,
I mean, Mario Draghi again expected to unpick those 2 interest rate rises we had from Jean-Claude Trichet's reign earlier this year. Of course, by doing so, I mean, what he's saying is, yes, we should be cutting interest rates, but more important than actually cutting those rates is the message that it sends to the market about policymakers' priorities.
It's not that 1/4, 1% is going to change the world. It is signals, it's a language, it's a message to say the institutions are biased in favor of getting growth back on the books. Nobody is losing a lot of sleep today about inflation.
Except perhaps, Mariam, of course, the poorest, because many of them, if they're on benefits, their incomes they don't go up as much, and so they get hardest hit by inflation.
That brings us back to this issue of income inequality. Well, thank you so much, Elliott Gotkine, bringing us that interview with OECD Secretary General José Angel Gurria.